Hi, welcome to this video decade, which is all about Forex trading lessons for success. And there's 10 of them today. And the 10 lessons are ones that took me a good while to learn. I wish I'd learned them when I first started trading straight away. If I had it done, I'd have saved myself a lot of money. I'd have avoided a lot of stress and also putting in a lot of time and effort to Forex trading, which was not necessary. Now, the lessons themselves include overcoming specific obstacles which most beginners face. Now, you might think the obstacles are fairly obvious. They are. However, overcoming them is pretty difficult, and I'm just going to go through some easy ways to overcome the common obstacles that cause beginners to fail, and also some lessons which really relate to doing things that other traders don't and avoiding conventional investment wisdom, which most traders believe. Conventional investment wisdom is generally wrong. You've got to do things different to the majority. So 10 lessons really to overcome the main obstacles to trading success and also get an edge by doing what most traders will never do. Now, what we're going to do is we're going to go and look at the 10 lessons in more detail on a storyboard. So let's take a look at them and discuss how they can help you become a consistently profitable Forex trader. Right, let's have a look at 10 trading lessons for success. And in terms of order of importance, they're in no particular order. I think they're all important. And in terms of, let's start with point number one, taking small losses, good money management. We know that's the key to every trading strategy being successful longer term. But most beginners have a problem. They'll use too big a trade size. They'll basically move stop losses back when they're losing, increase their risk, or they'll use those stops at all. It's a common problem. It's very easy to say overcome it, but it's very difficult when emotions get involved. A lot of traders get angry when they get stopped out. They get frustrated when they're in a trade. They're nervous about their stop. The way to overcome it is to basically get a trading edge. Okay, this might sound obvious, but most traders don't do it. Get a trading edge that you can define specifically, that you are confident in, that can lead you to longer term trading success when the majority of traders fail. Then you'll be very comfortable about getting stopped out. Now, in terms of that being obvious, it's not obvious to most traders. What they'll do is they'll trade. They can't define their trading edge. Well, if you can't define a trading edge, you haven't got one, and you need one to beat the majority of people who lose. Also, a lot of traders will say they've got a trading edge and repeat it to you, but they haven't researched it themselves. They've just taken someone else's word for it. That's not a trading edge either. You've got to do your own research so you can be confident in the logic of your strategy. And my favourite example of this is all the traders who pick pattern trading strategies to try and make money from the Forex markets. They plainly don't work. They're based on unsound logic that the past will repeat into the future. It's complete nonsense. They haven't done their research. That's just one example, okay? But most Forex traders just don't do enough research into how and why Forex prices really move. They've got no concept of volatility and noise levels in the market. Well, if you don't have a concept of volatility or understanding of it, noise levels, you're going to lose, okay? So you've got to do your research. Once you've got that trading edge that you're confident in, that you've researched, you'll find taking losses just easy in terms of you won't get stressed out, you won't get emotional about them, you know or will know that your trading edge will prevail longer term, okay? Real basic stuff, but most traders don't do. Point one. Point number two, technical analysis fooled by hindsight. There's a huge amount of retail traders, the majority, who want to use technical analysis only to make money from the market. It's not just predictive pattern strategies, but other ones as well. Most technical analysis is kind of junk. It doesn't work in the real world. You get, for example, the advanced trading strategies. Well, you've got to keep it simple. If you just complicate a strategy with lots of lines and so forth, you just fooled by hindsight that a lot of the price action in the past means something when it doesn't. And I think traders just really think that technical analysis, there's some sort of scientific formula It's got severe limitations, okay? The only technical analysis that works is very simple analysis that is based upon looking at the right of the chart, what traders are doing now, not what they were doing left, several months before. That's all gone, okay? And my own view is you will not make money just using technical analysis on its own. It becomes really effective if you use it with fundamental analysis, and more importantly, sentiment towards the fundamentals. So, in terms of point number 3, fundamental analysis on its own, it's very difficult because you get what I call economic data deception. And what I mean by that is all the data might look good for a currency, but you don't know how much of it is discounted. You've got to look at trader sentiment, work out how much of the good or bad news is discounted. Once you've got the sentiment of the market, then you can trade and use your technicals. And the technicals can be kept very, very simple and nothing complicated. And we just use support and resistance. Okay, but because you've got that directional bias from the sentiment towards the fundamentals, it's highly effective. Okay, all the top traders in the world do sentiment analysis. You should too, in my view. But most traders won't do it. And it's not complicated. A lot of traders think it's complicated. It's not. Okay, done plenty of videos on this. Now, in terms of point number 4, this is a real problem and took me years to overcome. It's you make an opinion on a trade. Okay, once you've made your opinion, you can be subject to what's called confirmation bias. So if the trade isn't going your way, for example, you get confirming evidence to support your view. Okay, and you stick with your opinion. And we all know it's more difficult to change an opinion once you've made it than it is to change it. That's psychologically proven. So basically, you've got to overcome confirmation bias, and it's very difficult. It sounds like it's easy. It's not. What you have to do is, do the supporting arguments for your trade or your trade idea, but run the counter trend argument as well. And then look at both without any bias. It sounds easy, but it takes a bit of practice. Now, in terms of point number 5, don't try and understand too much. Traders try and understand too much. They want to understand every twist and turn of the market when much of the movement is noise, or they skip from strategy to strategy looking for the holy grail. Don't bother. Get something simple. Don't try and understand too much. And also, if you're in a trade, there's a great bit of advice in my view. If you don't understand why the price action is doing what it's doing, get out the trade. And never enter a trade when you're not really sure or have a definitive view on the price action. Okay, you don't need to understand too much in Forex trading. What you don't understand, understanding that is very, how would I put it, a good thing to know. Traders just want to understand too much. So moving on to point number 6, anchoring and comfortable, don't buy pullbacks. Traders tend to anchor price. What I mean by that is you get a big move up from support. The trader immediately doesn't want to buy because they've anchored to the lower levels. They want to pull back. Well, very often, and more often than not, you're not going to get the pullback. Markets are not that easy. Pullbacks are comfortable. You've got to do the uncomfortable and come in on the move and appreciate you've missed a bit of it, but there could be a lot more ahead. Also, in terms of anchoring, traders tend to anchor to their entry price. So if prices move up a little bit, okay, and then they start to come back a little bit, okay, the trader hasn't got much profit at all. He still believes in the trade, but coming back towards entry, he'll snatch the trade out, move the stop to entry, just to avoid taking a loss. Okay, you don't want to do that. Okay, it's a really common mistake. Do not anchor. Okay, look at price action as it is and where you think it is going to go. You don't need perfect entries. Do not move stops to break even or up too quickly just to protect a minor profit, because you need big profits. If everything looks good, you let the profit run. Okay, it's a major problem, anchoring. Point number 7, effort, frequency, bias, and patience. There is a tendency for traders to want to make too much effort when they trade. They want to trade, they want to make money, and they'll look for opportunities. But they're very often low odds opportunities, just looking to trade. They should be patient. Okay, you don't need many big trades to make money from the markets. You don't have to trade that often. And I think, effort is really hard to overcome. It's just natural within us to think the harder we work, the more we're going to get out. But that doesn't apply in Forex trading. Very often, or more often than not, in Forex trading, the best trade is no trade. You can't lose any money. You only want to risk your money when everything fits in terms of your strategy. You are patient and you wait for those opportunities. Frequency bias. One thing that causes traders to trade too much is looking at price action. If you look at price action in the short term, our brains are geared to pay attention to that action. Okay, so when you see prices moving on a quote screen, it can look important, whereas no levels have been violated, but it kind of messes with your psychology. If the price is going against you, you want to jump out. Maybe it's going in your favor, you want to jump in and put more on the trade. So you want to avoid watching price action too much. I think it's a major problem. And I know a lot of traders are taught that they can trade off like a 5-minute chart, 15-minute chart, 30-minute, 1 hour chart. No, you can't. You're just trading noise. You're being fooled by hindsight by thinking that price action means something. Yeah, sure, it looks orderly after the event, but it formed randomly. So big mistake. Be very patient. Don't make too much effort. Stay away from price action. Only take very high odds trades. Point number 8, focus on expected payouts and not market probability. Very often you get big, strong bull or bear trends, and the market says the probability of it going higher is really good. And very often it's not, okay, because you've got a consensus coming into play. You want to be focused on the expected payout. So how much will you make against your risk? Okay, very often the best expected payouts against risk are when the market thinks the probability is high of a continuation of a trend. Okay, you go counter and you've got small risk and a big payout. You go with the market probability, you've probably got a low expected payout against the risk. It's not really understood by most traders. In terms of expected payouts, we'll be going for 3-to-1, 5-to-1 or more against our risk. And we'll very often go contrary to the market majority view because your expected payout is so much better. And you've got to think about it. If you've got 5-to-1 risk to reward in terms of your trades, you can lose 4 of them, win 1 and break even, can't you? So you never want to go with the market majority. You've got to be very contrary. Okay, and you've got to feel uncomfortable. Successful traders don't do comfortable things. They don't go with the consensus market view. Point number 9, variation of bet size and performance. Variation of bet size is one of the biggest things you can do to increase your profitability and reduce your risk. So you don't keep a consistent bet size, which a lot of people teach. If you're losing, you drop your bet size down. Because you don't want to come back too quickly. You just dig yourself a bigger hole. It takes time to come back from a drawdown. Don't hurry it. If you're making money, why not increase your bet size? You've got some money in your account as a cushion. You can really push your trade performance forward. In any odds-based game, it's proven that variation of bet size will increase the potential reward and decrease risk. Last point number 10, trading is 90% psychology, 10% method. It is. Anyone can learn the simple methods that can work. Very few people can master the psychology side. Obviously I've gone through some key psychological problems in this video. Psychology, you can master your psychology, you can win, and anyone can learn a simple method. Now, we've done plenty of videos outlining these points in more detail, and I just think they're real keys to trading success. So I hope you enjoyed the 10 lessons. Thank you very much for watching me as usual. Take care. Have a good day.